This gets back to our overall thesis, Matt, which is that we believe we've been in sort of a 3-year rolling recession, and that the end of that recession ended in April with the tariffs. That was the final capitulation. So we think that's a new bull market, right? We think the bear market ended in basically April. It was a pretty nasty one. There were several, along the way, and that was the final flush. And now we're in a new bull market, and capital markets activity is just another sign that that analysis or that conclusion is probably correct.
A new bull market, that seems like a pretty big statement. And what does that imply of what the road ahead looks like? I mean, you think about now through the end of the year, we've heard a lot of folks say that, okay, maybe we get a dip. Maybe we ultimately finish 2025 higher from these current levels, but expecting some volatility on that path.
Yeah, but that's different. Volatility in a bull market or bear market is normal. I mean, you want to see some consolidation. I'll go back to 2020, that's probably when we were probably the most out of consensus bullish as we are today, like on earnings. So in the spring of 2020, we were very bullish out of consensus because of our earnings work, and our work's telling us the same thing. In 2020, it was a straight line up, right? Didn't really let anybody in until September, and then we had a consolidation for about 6 or 8 weeks where we had 2 8-10% drawdowns and we went sideways. But if you look at the chart, it's not even perceptible. Okay, so consolidation, volatility, correction. I hope we get some. That would be normal, as opposed to just sort of going straight up and going parabolic here. So I think that's normal. I expect it too. We've said that in the third quarter. We think this is the best chance we could have for some correction or moderation, if you will. But I want to be very clear. It's still early in the new bull market, so you want to be buying these dips.
Well, and there is some frothiness, right? It sort of feels like silly season when you look at how much Mark Zuckerberg is paying people to come on to his super intelligence unit, right? $100 million bonuses. And then you get something like Palantir, which has forecast sales of $4.15 billion, and it's worth $415 billion. Like 100 times sales is pretty nutso, right?
Yeah, no, I mean, I think it'd be naive to sit here and say it's not getting a little frothy in parts of the market, but that's what new bull markets do, right? I mean, and even in existing bull markets, you get frothiness, right? Just like you get over pessimism in bear markets like we got in April. So I think it's part of the deal, right? And as investors, our job is to find good risk rewards, okay? And by the way, a portfolio can have some speculative assets in it, right? It just shouldn't be 40% of your portfolio. But right now, I'd say the risk reward still looks pretty good where the revisions are positive, things like industrials, things like financials, parts of the technology sector. These are areas that are continuing to show positive earnings revision breadth, and there's definitely still value in some of these pockets.
So we were talking about froth. Remember, we had meme mania reignite just a couple weeks ago, which definitely was a sight to behold. When it comes to this new bull market that we're in, what do you need to cooperate? I go to the bond market, for example. I see 10-year yields at 4.23%. We had been hanging out around 4.5%. It seems like we've reset a little bit lower here. Are these the levels broadly that you need long-end yields to stay in for this bull market to really flourish?
Yeah, 450 has been the level we've been talking about for several years. When you get above 450, equity multiples don't particularly like that. So 423, it seems like we're in a fine zone. I think to continue the bull market, you need the things you need, the ingredients you need is positive rate of change on growth. Okay, we have that from an earnings standpoint, and you have policy that isn't inhibitive, right? Or inhibiting that growth. So both fiscal and monetary policy looks like it's okay, and it appears as if the Fed, maybe they're not going to cut in the short term, but all signs point to the next move will be a cut. So you have supportive policy, you have positive rate of change, you have good flow dynamics. I mean, those are all the ingredients you need.